Did you know a simple schedule can stop one bad market day from running your plan? Dollar cost averaging is a long name for a very ordinary habit. Investing the same amount on a regular schedule, whether markets look calm, scary, cheap, or expensive, it cannot make risk disappear, but it can replace a stressful guessing game with a repeatable process. In the next few minutes, you will see exactly how the math works, when the habit helps, and when it can cost you returns. Here is the payoff up front. Dollar cost averaging solves a behavior problem better than it solves a forecasting problem. Better than it solves a forecasting problem. It helps you keep acting when headlines are loud because the schedule decides when you invest. It also changes how many shares you buy at different prices. What it does not do is tell you which investment is suitable, guarantee a profit, or prove that waiting is better than investing money you already have. The United States Securities and Exchange Commission, through investor.gov, defines dollar cost averaging as investing equal portions at regular intervals, regardless of market ups and downs. We will shorten that to DCA, but only after defining it. The equal amount matters. The regular interval matters. And the rule that you continue through both rising and falling prices matters. Changing the amount because of a prediction is a different strategy. Imagine that every payday, $50 moves from checking into an investment account. That may already happen inside a workplace retirement plan. The money arrives as you earn it, then buys whatever the selected investment costs that day. This is different from receiving a large pile of cash and deliberately leaving most of it uninvested for months. We will compare those two situations later because the trade-off is not the same. Now, for a 4-month example, suppose you invest $300 each month in the same broad investment. In month 1, each share cost $12, so $300 now buys 37.5 shares. Fractional shares are available at many, though not all, brokerage platforms. In month 4, the price returns to $12 and you buy 25 more shares. Across 4 months, you invested $1,200 and accumulated 117.5 shares. Divide the $1,200 invested by 117.5 shares. Your average cost is about $10.21 per share. At the final $12 price, the shares are worth $1,410. That is a hypothetical snapshot, before fees or taxes. It is not a promised outcome, and a different price path would produce a different result. This is the counterintuitive part. If you are still buying for a long-term goal, a temporary price drop lets each new dollar purchase more shares. The falling number can feel bad because the shares you already own are worth less. At the same time, the next scheduled contribution buys more. Both statements can be true. Lower prices are not automatically good. They only help if the investment later recovers and remains suitable for your plan. Dollar cost averaging does not turn a bad investment into a good one. If a single company fails, repeatedly buying its falling stock can simply concentrate your losses. That is why the schedule should be separated from the investment choice. Investor.gov explains diversification as spreading money among different investments to reduce risk. A diversified fund may help, but a narrowly focused fund can still leave you concentrated in one industry. The strongest case for DCA is emotional consistency. Without a rule, a market drop can trigger a loop. Fear says stop, recovery begins, relief arrives late, and buying resumes after prices are higher. A schedule cannot remove fear, but it can reduce the number of decisions fear gets to control. Automation makes the rule practical, because the transfer and purchase can happen before a dramatic headline asks for your attention. Consistency also reduces the pressure to find the perfect day. Perfect timing is visible only in hindsight. Before the fact, every price comes with uncertainty. A fixed schedule says, "I will not pretend to know which Tuesday is the bottom. I will decide the amount, interval, and investment in advance. Then review the plan, occasionally instead of renegotiating it every morning." Now the limitation. Suppose you already have $1,200 ready to invest on day one. You could invest all of it immediately. That is often called lump sum investing. Or you could invest $300 per month and hold the balance in cash. FINRA notes that gradual investing often produces lower returns than lump sum investing over longer periods because some money waits in cash instead of participating in market gains. Use a rising price example. Imagine prices of $10, $11, $12, and $13 across 4 months. Investing $1,200 at $10 buys 120 shares. At $13, those shares are worth $1,560. Spreading the purchases into 4 equal parts buys about 105.35 shares, worth about $1,370 at the same final price, before fees and taxes. That does not prove lump sum always wins. If the market falls soon after day one, gradual investing can reduce the short-term damage because part of the money is still in cash. The point is a trade-off, not a contest with one permanent champion. Immediate investing maximizes time in the market. Gradual investing can soften regret and early downside. Your time horizon and ability to tolerate losses affect which risk feels more important. Risk number 1 is the wrong time horizon. Investor.gov describes a time horizon to add. Creating vrace cum Freddy at Karichin. Investing Fredding bull for regular bills. If income changes, adjust the future amount deliberately rather than reacting to a market headline. Review the plan on a calendar, perhaps a few times a year, and whenever the goal, timeline, or household finances materially change. For money arriving from each paycheck, regular investing does not mean you are intentionally delaying a lump sum. You are investing funds as they become available. For an inheritance, bonus, or accumulated cash balance, spreading purchases means choosing to keep some money on the sidelines. That distinction clarifies the question. Are you building the habit from future income or deciding how quickly to deploy money already available today? When markets drop, run a short check before changing anything. Has the goal changed? Has the time horizon shortened? Is the investment still diversified and suitable? Can the scheduled amount still fit the household budget? If the answers are unchanged, the original rule may still be doing its job. If the facts have changed, update the plan. Because of those facts, not simply because a red chart feels uncomfortable. Recap the full idea. Dollar cost averaging means equal amounts at regular intervals regardless of market direction. It buys more shares at lower prices and fewer at higher prices. Its main strength is disciplined behavior. Its limitations are equally important. It cannot rescue a poor investment, eliminate losses, replace diversification, or guarantee that waiting with available cash will beat investing it immediately. Time horizon, emergency savings, and fees still matter. Would a fixed schedule make market drops easier for you to handle? This video is general financial education for a U.S. audience, not individualized investment. tax, or legal advice. Investing involves risk, including possible loss of principal.